Hello, my name is Mark Fulton and I'm a research advisor to Carbon Tracker, and I'm talking to you from Sydney today. Welcome to Carbon Tracker's synthesis of its carbon supply cost curves covering oil, gas and thermal coal. The time frame focuses on supply and potential production out to 2035 and capital expenditures, or CapEx, out to 2025. We look for unneeded potential production and unneeded CapEx in terms of key categories, countries and companies. This starts with going back to the basic research on each fossil fuel and then using a common currency of CapEx in US dollars and production in terms of carbon in gigatons to compare them. As in all our previous studies, we look at demand levels as our starting point. We have a 2 degrees centigrade compliant, or 450 parts per million climate budget demand level. We have a Carbon Tracker low demand scenario, or LDS, which is somewhere in between the IEA's new policy scenario and the 450 parts per scenario. However, given the recent publication of 2-degree stress tests by companies like Statoil and BHP, we have chosen to emphasize the results in this context. We then fit the demand to the supply curves with particular emphasis of what this means for new projects as opposed to existing production. The supply data comes from recognized industry databases. For oil and gas, from Rystad Energy, and for thermal coal, from Wood Mackenzie Limited. In this sense, we do not pick up absolutely all potential supply, but what the providers can identify and believe are on the radar of companies. This can be thought of as BAU, or business as usual. This makes sense for an exercise aimed at investors on a 10 to 20 year horizon. However, it does mean that from a carbon budget standpoint, this is a subset of what might be found, albeit a substantial one. Indeed, the IEA's World Energy Outlook for 2015 talks about 40 to 50% of oil and gas reserves as unneeded and 80% of coal out to 2040 in a wide reserve sense. Our analysis shows the potential production not needed at the high end of the cost curves has significant private sector exposure, as well as capital market links. Our methodology using the BAU industry-based supply curves shows out to 2035, 11 to 12% of the entire supply curve of oil and gas are unneeded, but the private and public ownership is fairly equal of unneeded supply. Over 40% of the entire thermal coal supply is unneeded, with the seaborne and US markets being mostly private and China and India being more public, where government-level solutions are crucial. So looking at our key conclusions, the first point is that coal and oil go ex-growth on both our LDS and the 450 demand scenarios, while gas grows slightly. We believe that no new mines are needed at all in 450 for coal, and any new demand can be met from existing mine expansion. For oil, a third of new projects are unneeded over 450, and for gas, a quarter. Unneeded CapEx in a 450 scenario for new projects is over 1.3 trillion for oil and nearly 500 billion for gas, very significant for investor portfolios, but only 180 billion for coal, given low CapEx intensity. However, in the industry BAU supply curves, thermal coal has unneeded new potential production associated with 72 gigatons of carbon, compared to 25 gigatons for oil and 9 gigatons for gas. So any misread of demand by coal companies, especially public-owned, could severely affect the climate. The interaction of supply and demand at 450 results in break-even prices for the last marginal barrel of supply that would need to rise to over $80 or higher for oil, using a 15% IRR for sanction. This is challenging for companies to determine when this might emerge in highly volatile markets. For LNG, prices need to rise to $10 or so, and for the seaborne coal markets, for 62 purely for existing projects to make a return with no new mines required. So in conclusion, I would emphasize the relevance of this type of study and analysis both to investors and to companies. Earlier this year, we put out a blueprint for managing fossil fuel risk, and in that we stressed the integral nature of doing a 2-degree stress test. What we have found, looking at what we've seen so far, is that the level of detail is somewhat lacking, particularly around capital planning and capital expenditure. Therefore, I would now pass on to James Leeton to tell you more about the details and how we have looked at this.